All right, we're beginning the reading, Understanding Business Cycles. Super interesting. For the first, I think, 7 or 8 screens, I'm going to rely a lot on the exhibits from the reading because they summarize all of those lists of points very well when we get to all the different phases of the business cycle, the 4 phases. And we look at different indicators across those phases. There's a bunch of lists under them. It's easier just to present the exhibits. So let's begin with LOSA, describe the business cycle and its phases. And the first task that the reading sets out, which I think is a wise task to do, is to define what we mean when we say the business cycle, because this definition has changed over time. Let's look at the classical view of what a business cycle was, and it's this very first exhibit at the top of the screen where we measured output, and the peak of any cycle was where output would peak before it pulled back a little bit. The trough was the bottom of the output or the measure of output before it would start to rise again. And peak to trough were typically very short periods, and trough to peak were typically very long periods, which coincided with equity market cycles very well. You tend to have short bear markets, anywhere from 12 months to 18 months, which would be considered a long bear market, followed by very long bull markets, 5 years, 7 years, sometimes as long as 10 years. However, this isn't very useful because it doesn't really help policy very much. Let's move over to the growth cycle one, which is at the bottom of the screen, and we'll see how much more useful it is in terms of setting policy, especially central bank policy. So I'm going to just draw on the exhibit. Here is what we just saw on the upper screen. Here is our classic view of the business cycle in terms of output. And what we're going to do is we're going to fit a trend line to that data. Maybe this is historical data. This is trend growth. That's the underlying growth. You have short-term fluctuations around the long-term trend growth. And we're going to define business cycles this way. That expansions are periods of time where actual output is greater than what trend output would be, and recessions will be characterized as periods of time where actual output is below trend growth. So now we can start thinking about output gaps, and this is a much better to inform policy with, because we could have growth, however our actual growth is below what it should be, below what the trend growth would be, so that we have a negative output gap. Well, then we can step in and have policies that support the economy to get it back to its trend growth. And if we have periods of time where our actual output exceeds trend growth, well, then we start to think about inflation and raising interest rates and maybe trying to slow down the economy a bit, because we don't want inflation just to run away. We define peaks and troughs a little bit differently as well. The peak is the greatest distance, the largest output gap. This is up here, we say, when we have this, we have a positive output gap between actual and trend GDP. So where the gap is the widest, that would be the peak. And there it is down here. This is what the business cycle now looks like. It looks like this. It's a little bit more periodic, although it's not quite periodic. It's a little more periodic by the very nature of fitting a trend line. If the business cycle, the classical view of the business cycle, were different, the trend line would still produce something that is still more periodic. And the trough is the widest distance between actual, there's actual, versus what trend should be. So here, actual output is below trend output. The economy is performing below its potential. Maybe it needs something, right? A little push. And that would be then considered the trough. Notice what happens here when we move to this definition. Troughs in this definition happen later than in the classical view, and peaks in this definition happen sooner than peaks in the classical view. So fluctuations, when we define growth cycles, this is fluctuations in output around a long-term trend versus the classical view. Peaks are earlier, troughs are later. All right, let's look at a third definition of business cycles. This is growth rate cycle. Not used a lot, but it can be interesting if you want to have a look at it. Again, here is our classical view. Let's find a color that works here. Here's our classical view of the business cycle. And everything else we've seen, except we have a new line down here, which is this longer dotted line. We have to explain this curve right here, and I'll try to draw it out as best I can. We have to explain this one. And this one is explained by following the traditional or the classical cycle and taking a derivative all along the way. This is the derivative. This curve here is the derivative of a classical business cycle. So let's see if we can line up some of these points down here. And for that, we're going to need a ruler, and let's just draw a tangent line right here. We'll draw a tangent line. Notice that that tangent line is very steep. It's the highest slope, which represents the highest rate of growth. That then becomes the peak of the business cycle, where output growth is at its highest. And of course, if we go over here and we draw a tangent line here, we have a downward sloping tangent line, negative slope. So the area where the steepest negative slope happens would be the lowest rate of growth. That would then set where the trough is. And where the tangent is parallel to the long-term trend, we'll just line up our ruler on the long-term trend, and we'll shift it upwards up here. You'll notice this line up here is parallel. And if we shift it lower, we'll draw this parallel line over here. So at this point in time, and at this point in time, growth is equal to the growth rate, and we're talking about not the actual output, but the growth rate in output is equal to the long-term trend growth rate. So if we follow this line down, we should intersect between the slope of the business cycle versus the slope of the trend line. You have a trend line that's linear. What's the slope of a linear line? The first derivative would be a constant, so that is why this line here is straight. And where we have our tangent line that's parallel to the trend line, they should intersect. And of course they do. There's a tangent line that's parallel to the trend line, and it intersects at that, both of them intersect at that point. And an expansion is defined as a period of time where growth rate of GDP is above trend growth, and a recession or a contraction is defined as a period of time where the growth rate is below the trend growth rate. And again, it incorporates the idea of a growth recession as opposed to having a full-blown recession. Economists and practitioners generally use just the second definition of a business cycle, a growth cycle. The classical view, like we said, is not very useful. And it just adds another layer. It just adds the derivative of the growth cycle. So we can define the business cycle in terms of a growth cycle, or you can define it as the first derivative of a growth cycle. It's a lot of thinking to think about a first derivative, because you have to be thinking always ahead of time, because your signals are going to be way ahead of time. That's why the second definition of a business cycle makes more sense. That's the definition that'll be used throughout this reading. So when we identify phases of the business cycle, they are in terms of output gaps. All right, let's look at the 4 phases of the business cycle. And we make reference to the 4 phases by their relationship with potential or trend growth. So we look at the gap between actual and potential GDP. And when the gap is at its widest and shrinking, we have a recovery. Once the gap is closed and we start getting a positive output gap, as long as it's expanding, it's called an expansion until it hits a peak and then the gap starts to narrow over time. We call that the slowdown. Notice that actual output is still above trend. Not until we actually have actual output below trend do we enter a contraction, and the negative output gap is widest at the trough. And again, we're only going to know where those points were after the fact. Several quarters sometimes before we actually know. Sometimes even 2-3 years, depending on revisions, before you know exactly what month or what quarter was a peak or a trough. Let's look at the description of the phases from recovery through to contraction. In the recovery, the economy is going through a trough. We have a negative output gap, but the gap starts to narrow, as we can see here. In the expansion, the economy is enjoying an upswing. A positive output gap opens up. So we're not in an expansion until actual output exceeds potential output. Then we have a positive output gap. In the slowdown economy going through a peak, the positive output gap begins to narrow. Still, though, even though it's called a slowdown, the growth is just slowing down. We still have output that's above potential. And then only once we get into the contraction do we actually open up a negative output gap. The economy weakens and may go into a recession, and negative output gap opens. For activity levels, there are two ways to look at this. You can look at different measures of activity where higher is better. That means in phases here and here, those measures would be below average. And you can look at activity measures where lower is better. And in this region and this region, they would be higher than average. So let's just skip activity levels, just go to unemployment so you'll see what I mean here. In the recovery phase, layoffs tend to slow down. Businesses rely on overtime before moving to hiring. When you're coming out of a recession, a contraction, and business starts to pick up, you're not certain whether it's going to be sustainable. So you tend to use overtime before you begin to hire. Unemployment remains higher than average because we're below potential. If we were here, unemployment would be less than average. But unemployment is one of those things where the lower it is, the better it is. So it would be higher than average in a recovery. As we move into the expansion, businesses move from using overtime and temporary employees to hiring. The unemployment rate stabilizes and starts falling. In the slowdown, businesses continue hiring, but at a slower pace. Unemployment rate continues to fall, but at a decreasing rate. And this may be counterintuitive. If you think, well, if the economy is slowing down, why are businesses continuing to hire? Keep in mind, we still have a positive output gap. We are still producing above the potential of the economy. So the economy is still expanding. It's just expanding at a slower rate because you have an underlying trend that's doing this, that's growing at this rate. So if you have an output gap and you're just growing at this rate, you're still growing. Notice that you still have some positive upward slope here. It's just not as big as the trend. At some point in the future, you're going to have your output gap closed simply because you're not growing your actual output at the same rate that your trend rate is growing. So yeah, activity is still very robust. Companies are still hiring, but not at the same pace they were hiring. And then in the contraction, businesses first cut hours. They eliminate overtime and freeze hiring, followed by outright layoffs. Unemployment rate starts to rise. Companies, when they face a layoff, when they face a slowdown or a contraction in business, they don't necessarily lay off right away. They want to see if it's going to be a sustained period of a contraction, then they'll lay off. Let's look at activity levels here. Activity levels are below potential, but start to increase. Anytime we're talking about activity levels below potential, meaning that if we're measuring something, the higher the better, yes, they will be below potential. Activity measures show above average growth rates. Notice because we have a positive output gap, our activity measures should be above average. Activity measures are above average still here, but decelerating, moving to below average rates of growth. And activity measures are below potential. Growth is lower than normal. And for inflation, inflation is one of those funny things. If inflation was all market determined, we would expect to see periods of positive inflation and periods of deflation. But you have a central bank whose mandate is to promote price stability, and part of promoting price stability is to have moderate but positive inflation of 2%. They don't want to see deflation, so we never actually get deflation. Prices still go up in contractions, they just go up at slower rates, so the rate of inflation slows down. So in a recovery, inflation remains moderate, probably below the central bank's target of 2%. Maybe inflation is 1% here. Inflation picks up modestly. It starts moving towards the 2% target. Inflation accelerates further. We've exceeded the 2% target. We might be moving to the upper bound of comfort for a central bank, which is 3%. Here they'd be very interested in raising rates quickly to decelerate inflation. And here inflation decelerates, but with a lag. Now, pay attention here. Inflation decelerates. It doesn't say that we have deflation. It says inflation decelerates. That's called disinflation. So if in one year you have inflation of 3%, next year you have inflation of 2.5%, inflation of 2%, inflation of 1.5%, that is called disinflation. It's still inflation. Prices are up 3%, prices are up 2.5%, they're up 2%, they're up 1.5%. So prices are still going up, but at a slower rate. That's not deflation, that's just disinflation. Okay, on to LOSB. Describe credit cycles. And this is really describing the availability of credit in an economy, from very tight credit conditions to very loose credit conditions. And many practitioners use the term credit cycle and business cycle interchangeably. And for many sectors of the economy, it's fair enough. The correlation between the availability of credit and the activity in a sector is high enough that you can actually conflate the two and talk about a particular period in the business cycle corresponding to a particular period in the credit cycle. But when we get to housing, it's slightly different, and I'm going to save most of the credit analysis conversation to the point in a few screens here where we do talk about housing, and I'll show how the credit cycle affects housing in terms of the price of housing, the demand for housing, and construction. But let's just work with what we have right now. In a strong economy, there is high credit availability on favorable terms. Banks are very willing to lend because in a strong economy, default rates tend to drop. So the probability of a loan going bad is lower in a strong economy because there's plenty of cash flows available behind every project or behind every loan. So there's a lot of credit availability on favorable terms. This often leads to asset price and real estate bubbles. I mean, we only have to look at what's going on in late 2020, early 2021. Interest rates you're talking on the short end of the curve in terms of basis points, not even 1%, but 20 basis points. Mortgage rates have never been lower, and property prices have never been higher. You go try to buy a home now and try to find a decent, reasonable home for $500,000. Good luck. You're going to be paying $800, $900 to get into a medium type neighborhood. If you want a more upscale neighborhood, you're $1.5 to $2 million. Even in secondary markets, you don't even have to be in a Vancouver or a Toronto or a San Francisco market. You can be in a secondary market, and housing prices are unbelievable. Well, that's a result of very, very low rates. Often leads to asset price and real estate bubbles. It amplifies business cycles. We can think of businesses that use a lot of financial leverage. What happens when sales increase? Their return on equity really skyrockets because they're heavily leveraged, which means that their interest cost is fixed. So as their sales go higher and higher, it really juices returns. However, that also works on the way down. You suffer badly, right? So amplifies business cycles on the way up and on the way down. More extensive expansions, deeper recessions. So if you want to avoid these big busts, you have to try to find some kind of policy that slows down the expansion of private sector credit. In a weak economy, you have very tight credit markets and you have higher rates. Higher rates because banks are saying, listen, the probability of default is significantly higher, so there's a bigger risk in the interest rate if I'm going to lend money. And I'm only going to lend it to really good people, to really good customers that have really great credit scores or credit ratings. So that's described as a tight credit market. Credit cycles tend to be longer, deeper, and sharper than business cycles. We've already talked about the deeper and sharper. Usually when the economy is good, credit is really abundant. When the economy is poor, credit is really, really tight. They tend to be longer. We'll see this when we get to real estate. I'll draw one out. Growth or contraction in credit. That is the stage of the credit cycle. We either have growth in credit or contraction in credit. Will determine the direction in housing and construction markets, and this is huge for housing and construction. If you want to slow down the increase in the price of housing, start to make it more affordable, you really need to raise those rates really high because suddenly affordability becomes a problem. When buyers start looking at those monthly payments and saying, well, I can't afford $1 million house now at 1.5% interest. I could for 30 years. But if it's 4.5% interest, I can only afford a $600,000 house, and suddenly buyers dry up, and now there's downward pressure on the supply of housing, or downward pressure on the pricing of the supply of housing. So it really does determine the direction in housing and construction. The benefit here, very, very low rates. Yeah, it makes housing unaffordable, but you get a construction industry boom. And the construction industry is a huge purchaser of raw materials, lumber, copper, bricks, all of the materials to build a house, and it's a huge employer as well. Growth or contraction in credit affect the extent of expansions and contractions. We've already mentioned that. A credit cycle contraction happening with a business cycle contraction will lead to a more severe recession. You can think of 1990, 1991. You can also think of 2007, 2008. And of course, growth in credit foreshadows policy action. Same with contraction in credit. When credit or private sector credit contracts too much, central banks step in and provide liquidity to banks on the condition, sort of wink, wink, nudge, nudge. You're going to lend it out, right? We're going to give you really cheap money, but you're going to lend it out, right? And, sometimes they don't lend it out, and when the Fed makes a bunch of liquidity available for banks to lend out and banks don't lend it out, that's called a liquidity trap. Strong peaks in credit cycles are closely associated with systemic banking crisis. So when we see credit expand way too much, very strong peaks in credit cycles, there is looming possibility or high probability of some kind of banking crisis on the horizon. With the increase in ratios, in liquidity ratios that banks now have to keep because of Basel III, that's meant to address those issues, that banks suddenly are not that eager to expand their credit simply because they have to, their equity ratios have to follow along with the increase in the assets in their balance sheet. So that sort of keeps them in check, or at least we don't know yet. We won't know until the next financial crisis if it actually is going to keep it in check. All right, we're on to LOSC. Describe how resource use, consumer and business activity, housing sector activity, and external trade sector activity vary as an economy moves through the business cycle. Here I'm going to rely on the exhibits that are presented in the reading because it's all really condensed and I think right to the point. Notes under each recovery, expansion, slowdown, and contraction for, here we have employment, sales, and production, and in the inventory sales ratio. And I would just rewrite this on the screen anyways. I know that I've had feedback about, using typing on the screen versus actual writing, and many people prefer the writing. But if you're just going to rewrite a whole exhibit, you may as well just put it on the screen and then just write over it in terms of what the big themes are. Let's look at employment across the four phases. We've already seen employment a little earlier, but let's just add a little bit more context to it. In a recovery, as we've seen, layoffs slow. Businesses rely on overtime before moving to hiring. For this over here, we would look the first Friday of every month in the U.S., and I think the first full week Friday of every month in Canada is the jobs report, which talks about how many private sector jobs were created, average hourly earnings, all that kind of stuff. So this is where we want to look at the average hours worked per week. That you might see very low job creation, but you see average hours worked per week beginning to increase and increase. And once you get to, start pushing 35 and a half, even though I know it's well below 40, that typically is a signal that there's going to be some job creation because you're maxing out hours per week. Unemployment remains higher than average. When we start to see average hours worked start to creep up, that's a very bullish sign for equities. Even though we're just in the recovery, the output gap is negative, where the indicators are still below average but starting to turn up. That's usually a very early sign to move into equities. In the expansion, businesses move from using overtime and temporary employees to hiring. The unemployment rate stabilizes and starts falling. Notice that it does it in the expansion phase. So we can conclude very quickly, employment is a lagging indicator. That if we're looking at the employment rate, it is rear view mirror. In other words, it's not going to help us determine where the economy is going because it's usually late to the party in terms of, look, by the time we have that number, we already have other indicators that are telling us where things are going. We'll see a little later on in the reading when we talk about leading, coincident, and lagging indicators that the level of employment is a lagging indicator. In the slowdown, remember now the slowdown, we still have a positive output gap, except it's narrowing now. Businesses continue hiring, but at a slower pace. Unemployment continues to fall, but at a slowly decreasing rate. And for this one here, we can look at the jobs report as well. And it's released again every Friday. And we look at the number of jobs that are created month over month. And we start to see something like this going into the expansion. When you start to see it doing this, that the job creation is rolling over, that's a clear sign that we're well into the slowdown, which is a bearish signal for equities. And in contraction, businesses first cut hours, eliminate overtime, and freeze hiring. We'll see this in the jobs report where the job creation numbers are very, very low, but we're starting to see average hours worked starting to decrease, and unemployment starts to rise. Look at sales and production, and here we'll combine it with the inventory sales ratio. In a recovery, sales declines slow. Going into a contraction, when actual GDP drops below potential, sales volumes drop. Here, sales decline slows in the recovery because we are past the trough and moving up into the recovery. If this is the long-term trend, we're somewhere down here, and the output gap is beginning to narrow. Production upturn follows, but lags behind sales growth. So what this is saying is that we will see an increase in sales. And typically production will follow along, but if sales are growing at 5 or 6%, production may only follow along at 2 or 3%, which means inventories are still falling while sales are increasing because you got to sell from something. So you're working off inventories at this time, even though you still have ramped up production and you've increased production from the contraction. The growth in sales outstrips the growth in production. Over time, production approaches normal levels as excess inventories from the downturn are cleared. So the inventory sales ratio, if in the this is a numerator and a denominator, if the numerator is dropping while the denominator is increasing, the inventory sales ratio begins to fall as sales recovery outpaces production. Very bullish signal in a recovery when you start to see the inventory to sales ratio drop. Moving to the expansion, sales increase, production rises fast to keep up with sales growth and to replenish inventory. So you got to ramp up very quickly to meet the increase in sales, plus you need to replenish those inventories as well. Where do we leave off here? This increases the demand for intermediate products, inventory rebuilding or restocking stage. So your ratio is stable because your numerator is increasing as fast as your denominator is increasing, and maybe your numerator is increasing just a little bit faster. Sales slow. In the slowdown, sales slow faster than production. So inventories continue to rise. So you're building inventories at this rate, but sales are starting to do this. So what's going to happen with the ratio? That ratio is going to start increasing. That is a bearish signal in the economy. Ratio increases signals a weakening economy. Economic slowdown leads to production cutbacks and order cancellations. And then finally, in the contraction, businesses produce at rates below sales volume necessary to dispose of unwanted inventory. So when they see this happening, they'll cut production because look at the sales keep dropping. The inventory will start to do this. That gap will widen. They're going to want to drop those inventories very, very fast. The ratio begins to fall back to normal. All right, let's move on to capital spending. And to determine levels of capital spending, we look at business conditions and expectations and capacity utilization, because these will determine the level of capital spending. Capital spending is the most cyclical part of the components of GDP. You'll remember GDP is consumption plus investment plus government spending plus net exports, with the I being investment. That's capital spending. Being very pro-cyclical. So it does. There's large increases in expansions and large pullbacks in contractions. And there are three big factors that interact to determine the level of capital spending. And that is current business conditions, the expectation for future business conditions, and the level of capacity utilization. To get at business conditions and expectations, the big report there is the PMI report. Let's see if I have a good color here. Is PMI for manufacturing. Also Philly Fed in the U.S. For the northern regions is a good survey as well. In the PMI manufacturing report, there are components. It's a diffusion index. There are components that look at expectations for the future, expectations for hiring, expectations for price increases, things like that. So it builds in expectations. So that, along with capacity utilization, will give you some indication of where capital spending is headed. So let's look at it through recovery, expansion, slowdown, and contraction. In recovery, excess capacity, that's a big thing right there, excess capacity. If I have excess capacity and business conditions are good, and I expect business conditions to stay good, I'm not really going to make a big investment because I have excess capacity. Excess capacity during the trough, low utilization, little need for capacity expansion, even if I think the future is going to be bright. There's still little need there. Interest rates tend to be low, supporting investment. It is at this stage where we see very low capacity utilization, very low rates, where we want to move into high operating leverage stocks. These are companies with very high fixed costs, very low variable costs, because as their volume begins to increase, they're not spending a lot of money in CapEx, so they have huge free cash flow, and their margins, their net income margins expand quite quickly. In expansion, companies enjoy favorable conditions. Capacity utilization increases from low levels. Over time, productive capacity may begin to limit the ability to respond to demand. Growth in earnings and cash flow give business the financial ability to increase investment spending. This is bullish for capital equipment sectors. Slowdown business conditions are at a peak with healthy cash flows. Interest rates tend to be higher, aimed at reducing overheating and encouraging investment slowdown. And investment is not as sensitive to interest rates as we're sometimes led to believe, especially when we go through the corporate finance section. We see that if we had higher discount rates, more and more projects become net present value negative. In other words, we would not invest in them. But companies don't invest to the interest rate. They invest to demand. If demand is there, if it's robust, they will invest. The cost of capital, in many cases, even at the peak of a cycle where interest rates are on an after-tax basis, it's still very cheap compared to the return they get on their equity, their ROE. So it's not that higher rates are a real drag on investment spending, but business conditions are the real drag on investment spending. And then contraction, companies experience a fall in demand, profits, and cash flow. Let's look, we'll draw a straight line across here. Let's look now at how that affects capital spending in the recovery. Capital spending is low, but increasing as companies start to enjoy better conditions. I've put in brackets here a big important point. CapEx focuses on efficiency rather than capacity. This also contributes to keeping employment low in the recovery. Remember, we talked about employment sort of being low in the recovery. Companies are not quite hiring back yet. Is because the investments they're making in capital spending are efficiency investments meant to reduce the number of workers they will eventually need. So maybe they're automating a little bit more. Maybe they're putting more algorithms in place that replace humans. But it's that kind of investment that happens in the recovery as they situate themselves for the next expansion. Let's get as efficient as possible. So in the next expansion, they can grow to the size they used to be and even bigger with less or the same employees they used to have. Upturn most pronounced in orders for light producer equipment. Typically the orders initially reinstated are for equipment with a high rate of obsolescence, such as software systems and technological hardware. So tech companies really do well coming out of a recession. At the very bottom, tech companies tend to do very, very well because of this type of investment going on. In the expansion, customer orders and capacity utilization increase. Companies start to focus on capacity expansion. Composition of the economies Capacity may not be optimal for the current structure of demand, necessitating spending on new types of equipment. And here's an important point here. Orders precede actual shipments. So orders for capital equipment are a widely watched indicator of future direction of capital spending. Where do we see this? We see this in the PMI report. PMI manufacturing, you're going to have, there is one line item in there that measures new orders. And I think it's for like 6 months out or something like that. But it measures whether new orders are increasing or decreasing. So it's within the PMI manufacturing data. And I don't think PMI manufacturing is unique to just the U.S. I believe there are European counterparts to this as well. In the slowdown, new orders intended to increase capacity may be an early indicator of the late stage of the expansion phase. Because remember, when companies are looking at business conditions and expectations, if business conditions are doing this while their expectations are this, nobody ever says, well, hang on, right about here we're going to get a surprise. No one ever predicts that. They just keep extrapolating out like this, and capacity will show up at this point in time, and they figure that we're here. By the time we add capacity, we'll be here. Well, it's a little too late if a downturn happens in that period of time. And listen, most downturns, you get a lot of economists saying, like, we think this, we think that, we think this, but no one ever really knows until it really happens. Companies continue to place new orders as they operate at or near capacity, which is the smart thing to do. I mean, you can't always be predicting the end of the world. I mean, at some point, somebody's going to be right if they predict it long enough. But in business, if things are good and you have expectations that things are going to proceed, it would be, I think, not a wise decision to say, well, let's just not do it in case there's a downturn. Because if there's no downturn, well, you're at a competitive disadvantage. If everyone is investing, you pretty much have to invest as well. Contraction, new orders are halted. And some existing orders canceled if they can be canceled because there is no need to expand. Initial cutbacks may be sharp and exaggerate the economy's downturn. This is why we say the investment component of GDP is highly cyclical. As the general cyclical bust matures, cutbacks in spending on heavy equipment further intensify the contraction. Maintenance is scaled back. That's an important thing. That helps preserve cash flow for companies. They'll take their existing capital stock and they'll say, well, let's cancel all the orders. And for the existing capital stock we have, let's sort of stretch out our maintenance schedule or cut back on it a bit. And it is meant to preserve cash flow. All right, now we're on the consumer. Just to recap where we've been, I recall Y equals C plus I plus G plus X minus M. We've already talked about capital spending, the investment component. We're now going to talk about the components of C, consumption, which is household spending on final goods and services. We'll, in a little while, talk about the trade balance, and then we will talk about G and the role of G when we get to theories of the business cycle. We'll see where G is involved there. But now we're talking about C, which is the largest part of GDP. It's the largest component. It is cyclical, but not as cyclical as capital spending. So on this exhibit, I've drawn some red lines to sort of delimit where the type of spending is. Here we have spending on consumer durables. Here is spending on consumer non-durables, and finally services. So before we go through the phases of the business cycle, let's just define these. Consumer durables are big ticket items, cars, boats, things like that, appliances, furniture. Consumer non-durables are things that you really don't have any choice on, also called non-discretionary, meaning you don't have much discretion over whether you want to buy it or not. Gives you some examples: medicines, food, household products. You can think of toothpaste, shampoo, soap, things like that. You don't really have a choice. You have a choice about the brand, but you got to buy something, right? These are called defensive sectors. And spending shows little change through the cycle because, again, it's non-discretionary. You don't really have a choice. Non-discretionary tends to outperform from some time at the beginning of a slowdown all the way through to contraction because they are called defensive sectors. So even while the economy is contracting, these types of companies that are in the non-discretionary sector tend to do fairly well because they're outperforming at that point. They're not performing any better than they would at any other time. It's just because everything is performing poorly, they are then outperforming. Then you have services, and services are of two broad types. There is the sort of discretionary services and non-discretionary services. So something that's discretionary, entertainment, things like concerts, vacations, outdoor eating, things that are really non-discretionary in services, communication, personal services. You can think of your gym membership. Most people never cancel their gym membership regardless of what's going on with the economy. I say most people. You continue with your cell phone bill, you continue paying your internet service provider. All of these are services, but very low in terms of cyclicality, whereas the other ones are very high in terms of cyclicality. So the services sector is sort of mixed cyclical. Some components are really cyclical, others are not, but when you combine them all together, they're kind of in the middle. Not as cyclical as durables, but more cyclical than non-durables. So, and they tend to outperform if we're thinking about a trough and a peak. Once we get, past the trough, once we're well into the recovery, not quite the expansion, all the way to near the peak, the services tend to outperform. At this point, there's a rotation into defensive sectors, and as we come out of the bottom, once we hit a trough and we start coming out, you would rotate into high operating leverage companies or companies that produce consumer durables. So let's go through our sectors here. In the recovery, we have seen this. Unemployment remains above average. Layoffs slow down. Businesses rely on overtime before moving to hiring. Consumer confidence starts improving. That's a very bullish indicator. When we see confidence improving, we feel better about moving into equities, because if my confidence increases, I am more willing to increase my current period consumption as opposed to saving for some future uncertain time. For durables, it doesn't really pick up yet in the recovery. Spending is limited as households postpone spending. However, the equities outperform in anticipation of an upswing in durable goods purchases. Defensive sectors really shows a little change throughout the cycle, so they're always there. By the way, most of these companies, if you're looking for dividends, they're very good dividend payers. And for services, spending is below average. It is probably average for the non-discretionary services and way below average for the discretionary services. In the expansion, hiring restarts, unemployment rate stabilizes, starts falling. This is really important. Consumers experience rising incomes. That is a critical sign. If you want higher consumption, you have to have two things. You have to have rising incomes and or rising availability of household credit. So if you can't make more money, can you get access to more money through more debt? So if credit expands, that's just as good. Incomes are better though. Rising incomes are absolutely great. Healthy employment prospects and greater confidence. So you take rising incomes and greater confidence. Look what happens here on durable. Spending increases. I'm more willing to buy a car on a 5-year loan if I think that for the next 5 years I'll be able to afford it, right? And again, for non-durables, not much changes there. Spending increases here in the services. So here's where you start to look at restaurants, hotel chains, airlines, movie theaters, things like that. The slowdown, business continues hiring, but at a slower pace. Now notice, they continue hiring, but at a slower pace. The slower pace is not a big deal. It's a slower pace, but incomes are still very strong. The total amount of income earned is not dropping. It's still increasing. So that big spending power is still there. Unemployment rate continues to fall. Incomes are still growing. Consumers remain confident. And we keep our eye on consumer confidence, especially late in a bull run. If you think it's late, you keep watching consumer confidence, because as soon as that starts to wane, as soon as my confidence starts to drop collectively, aggregately across the economy, there is going to be some pullback in consumption as consumers or households then say we should save something or start paying down our debt. But when you see their confidence start to drop, they will pull back current period consumption. It will lead to a drop in spending. Here on durables, spending is still above average, and for services, spending is above average. Everything looks great in here, right? That is this part of the business cycle. We're going up, and everyone's extrapolating it into the future. No one's doing this, right? Capital spending is going up this way. Consumer confidence is going up. Spending on durables, way above average. Spending on services, way above average. This will never end, they say. Until contraction. Businesses first cut hours of overtime prior to freezing hiring and starting layoffs. What's this going to do? You're cutting overtime right away incomes are going to decrease. You're starting layoffs, incomes are going to decrease in aggregate, right? Employment levels decline. And here we go, consumer confidence weakens. So you have decreasing aggregate incomes and you have decreasing consumer confidence. Durables are going to take a big hit. Consumer durables drop quite a bit. However, if you're in equities, the consumer non-discretionary is going to outperform, especially companies like Walmart. They cater to that sector because you still have to buy stuff. And here in services, spending declines, especially for the discretionary areas, hotels, airlines, movie theaters, restaurant chains, but not so much for the telecom companies, the internet service providers, etc. The economic data to keep your eye on all of this. Consumer confidence is a big one. ISM services, that will tell you the expectation of that sector, and it is a bigger chunk of the economy. Services make up about 70% of the U.S. economy versus 30% on manufacturing. Retail sales is also a good leading indicator. All right, just finishing up on the household here before we move to housing sector. Household incomes. We can look at household incomes in two ways, a measure of disposable income or a measure of permanent income. Disposable income is positively related to spending on durable goods. Permanent income excludes temporary income and unsustainable losses and gains. In other words, it'll strip out capital gains. Maybe you did well in the market that year, you have great dividends, great capital gains. Well, that's not guaranteed to continue. That really wouldn't be called your permanent income. This correlates well with non-discretionary spending. Not really a big thing that's watched. Disposable incomes are the big number. Only because, listen, even if somebody has temporary income, it's available for spending. That's the big point. It's available for spending. Household savings, an increase in the savings rate may indicate future caution, but the stock of savings may indicate future consumption potential without the need for an increase in income. Let's move on to the housing sector. Reports that we can look at: new and existing home sales. This will give us some idea of the level of demand. Building permits. This will give us some idea of the level of supply that will be coming on the market and the level of construction activity in an economy. The HPI, a housing price index, publishes the median home prices. It gives us some idea of affordability. All right, let's look at housing sector behavior in relation to interest rates. And the white curve here is the movement in interest rates, which is just the inverse of the credit cycle. So if I drew a credit cycle that looked like this, where you have high availability of credit, low availability of credit, interest rates would be doing this. You'd have very low interest rates, high availability of credit, low availability of credit, higher interest rates. So that is just the inverse of the credit cycle. Let me just get that off the screen. So here we are, we have rates that are dropping. Here's our housing pricing index, and as rates are dropping, it's going to start putting upward pressure on housing. Low rates support prices. This incomes divided by average home price. Again, if you look at the at housing reports, you'll get median home price. If you take the average income in the economy divided by the median home price, that is an indicator of affordability. If that ratio is high, that means affordability is fantastic because you have a low denominator and a high numerator. This is a sign that housing construction will probably start to begin or increase because housing affordability is there. There's going to be more demand. And as rates continue to fall all the way into the lower levels of where rates can go, you do have an improving economy. The housing price index is still moving upwards. Rising incomes, rates are still supportive of increasing in housing prices, so housing prices rise. You will get to some point where incomes tend to slow down, but the average home price continues to increase. The affordability index will drop when it's low. It means low affordability. A low ratio begins to work against higher housing prices. Same with rates increasing. Rates rising tend to work against higher housing prices as well. Here you'll have construction pullbacks. These are signs that, well, if housing affordability is low, demand is probably going to be low. The last thing we want to do is put more supply on the market at this point in time. However, you do run the risk of booms in housing sectors, booms and bust, and the housing sector is known for producing booms and busts. Late buyers coming in again because you have this going on and they're extrapolating into the future, right? Late buyers, whether it be momentum or speculation, you got to get in on it before housing prices go any higher. The train is leaving the station. You have some investors that go into new developments and they'll buy 5, 6 houses or 10 condos in a building, hoping to flip them after they're built. This encourages overbuilding. And when this finally happens, what happens? The inventories of existing homes for sale on the market begin to rise because all of these people, well, they got to dump them. There's going to be no buyers, so there's going to be a rush to put these on the market. Especially these days, the last 5 or 6 years, Airbnb has really made this popular, is buying a whole bunch of condos in primary cities and putting them on Airbnb. Well, that is a discretionary service. And what happens in a contraction is spending on discretionary services pull back. These entrepreneurs who had 8 to 10 different condos in different cities that they were using Airbnb for suddenly find that they can't make their mortgage payments. All that supply starts hitting the market, which then pushes down the price of those units. The central banks since 2008, 2009, central banks around the world have kept interest rates super, super low. I don't think anywhere in the developed world, the Western developed world, have interest rates on the short end exceeded 2% anywhere. So you've had a housing market that just kept going up and up and up and up to the point right now where the housing affordability metric, incomes over average housing price, is so low you would think that no one would be buying homes. Yet, you put a house on the market and within 3 days you have 15 offers on it for, 8, 9, 10% above asking price. I don't know how that's going to end. Let's look at the external trade sector now. And we're going to look at it in 2 different ways. We're going to look at imports separate from exports, because it is different economic conditions that fuel each one. And then we'll look at the role that the exchange rate plays in determining a level of imports and exports as well. So let's look at the domestic economy. Here is a business cycle for the domestic economy. We have a peak and a trough. Our imports will peak pretty much at the same point in time as all consumption. The economy peaks. In a contraction, imports will drop. In a recovery, imports will increase. For exports, we can't look at our economic conditions. We have to look at rest of the world, ROW. When we say rest of the world, it is pretty much the primary trading partners of an economy. As they do better, our exports do better. As they do worse, our exports will do worse. Here we are coming out of a trough into a recovery. Exports will rise. So this here is a representation of other countries' business cycle. This is a representation of our country's business cycle. Let's look at the role of an exchange rate. And this is not a business cycle. This is just, the pathway of the exchange rate. There's a very high exchange rate. There's a very low exchange rate. If we have a very strong currency, that encourages imports because our currency can buy so much more of foreign currencies. The goods in other countries appear cheaper because our currency can buy so much more. That means that exports are more expensive because foreigners would need more of their own currency to buy our local currency. And low rates does the opposite. It discourages imports because suddenly they become more expensive relative to the value of our currency. And it encourages exports. So countries do have a vested interest in promoting a lower currency because it can improve GDP. Remember, GDP, the last component of GDP, C plus I plus G plus X minus M. You can always get GDP up by getting exports up and imports down. You can do that with a little bit of help from the exchange rate. And it is, it's not short-term fluctuations that really matter. So short-term fluctuations have minimal effect. because a lot of supply contracts are for long periods of time. Companies that know that they're buying or importing regularly from a particular trading partner will engage in all sorts of currency hedging activities because they're not in the game for the currency, they're in the game for the product, so they'll lock in a specific exchange rate. But if a country's currency moves in a direction for a long period of time, then yes, it will start to affect the level of exports and imports. So it needs to move in one direction for some period of time. The reports to look at here, trade balance data. I think this is released monthly in most countries.